All right, welcome to another edition of the Chicks on the Right show, where we have our BFF and sponsor of the show, Zach Abraham from Bulwark Capital Management, join us to talk about all things finance and economy related. And we just saw a big fat headline today that says the Fed is done hiking interest rates, but they will only start to cut them mid 2024, economists claim. Do you agree with that assessment?
Yes and no. Meaning, I think that I don't think that they're far off, but I just think it's for a lot of different reasons than they think. So, first of all, I do think the Fed is done raising, and I've said it before. I think that, and it's weird to say because I've been an advocate of them raising rates for a long time, but I do think that they've raised them too far in the sense that they're going to get more things blowing up than they want to. So I think that you will see them for now. The Fed themselves are claiming that they don't expect to be raising rates till the end of 2024 or to the middle of 2025. I just don't. I don't see. Again, you never want to say never in this industry because look at the last 3 years, right?
Wait, they're not going to raise them, or they're not going to lower them.
The Fed has said they're not going to cut them. Yeah, so they're saying that they're right because theoretically, the way what those economists that article is about are saying is that the economy is really strong. It's the CNBC line that you're going to hear from anywhere else, and that the Fed will ease interest rates as inflation pulls back to target. Well, our whole thinking is if inflation still pulls back to target, what that means is that prices will keep accelerating at the rate of 2 to 2.5%. Well, prices are too high, right?
Yeah.
Home prices are at record inaffordability. Now, part of that is due to rates, but what the Fed wants is prices to come down. And so I think that they will be forced. See, the people in that article think everything's going so great, the economy is going to stay strong, inflation will continue to abate, and we're going to get this Nirvana-like soft landing, right? Where the economy, right? To me, it seems like kind of a nursery rhyme, nursery tale, child's tale. But I think that they're going to start cutting next year, and the Fed says they're not going to cut until the very end or the beginning of 2025. I think they're going to cut, but I think it's going to be because things are starting to blow up. And just since the last time we talked, we're seeing more and more of this happening in commercial office space. So just this last week, an office building in 2018 that was purchased for $66 million just got auctioned off for $15.5 million.
Oh my gosh.
Yeah. So, I mean, for those keeping score at home, that's like an 80% write down, right?
Oh my God.
Yeah. And another one in Toronto that just a couple weeks ago, $1.2 billion property, owner just handed it back to the bank, just gave the keys back. Right.
Oh
so,
my gosh.
Yeah. And we're also starting to see now, you're starting to see delinquencies, especially in the 40 years and younger category of the economy. You're seeing delinquencies that are rising to levels that we haven't seen since 2009 and 2010, meaning people aren't paying their bills for obvious reasons.
Yeah.
The alarming part of it is that you're seeing delinquencies climb. And I wouldn't say that they're climbing at a rate that would be like a flashing red light, but it's getting close to there. What is a flashing red light are the size of the delinquencies. That is mind-numbing because they're not normal, meaning people are defaulting on much bigger loans or are not paying on much larger size loans than would be typical. These are numbers in excess of what we saw in 0809. So I just think that the Fed has done, and I've said this before, but I think it's kind of a classic Fed mistake. I think they waited way too long to raise. I think that they have overcorrected to the upside. I mean, you guys are out there in the real, there's so many people out there that have money that are in a decent place, but aren't going to buy because of where rates are. Right. So, right. And as people don't buy, right, that slows down economic activity that feeds back through the economy. And so we just think, yeah, they're probably going to cut, but it's not for good reasons. Right. Because
will it matter? Will it help?
Probably not in the beginning because like we're seeing right now, they've been raising rates now for like 18 months. What'd they start? We started in January of 2022. Right. And what you see are people misunderstand this, and it happens going into every recession. They start raising rates. Guys like me say, oh, here it comes. And then for usually like a year to 16 months, you don't really see anything bad happen. And everybody's assumption is, oh, well, the economy can handle it. Well, just think about it, right? When you raise rates, even if you do it really aggressively, there are a lot of people that don't feel that. The only people that feel that pressure are people that are forced to refinance, right? People that have to go purchase a home. And so what we call it is a lag effect, meaning anytime you're using monetary policy or interest rate adjustments, it takes time to feed back through the economy. And like I said, what every single time happens is those lags, that time it takes, fools everybody into thinking there's no problem. And I just don't see any evidence that it's any different this time. And you're starting to see wages have stopped going up. Okay, they're not moving down sharply, but they've stopped going up. You've got the jobs numbers continue to get revised lower. You saw a very weak jobs print. Now, it wasn't horrible, but it was considerably lower than expectations recently. And we just think this is kind of the start of the process. And I think most people are sleeping on it.
Oh my gosh. So, I mean, the good news, I guess, is that like when interest rates are high, that means like savings accounts earn more, which is like the one bright spot, I guess, if there's to be a bright spot.
Yes. And this is kind of what, there are so many things like that right now that I actually think are really attractive, because one of the things people don't realize, and look, I'm not advocating for you to go out and buy a bunch of bonds right now, as people have seen. And the reason I say that is we think of bonds, they're safe, right? Well, if you look at a lot of bond funds, the average bond fund since January 1 of last year is down anywhere from, 20 to 30%, okay, in value. You look at the 30-year US government bond since January 1 of last year, it's down 63%.
Oh my God.
Okay. A government bond, right? The 10-year is down. The 10-year bond is down, I think, like 40. So I'm not advising, you can go out and lose a bunch of money in bonds, but I think everybody has been playing the stock market game for so long. And you look at how expensive stocks are right now in general, like for instance, if we look at Apple like a bond, right? Apple's a great company, not saying anything bad about it, but it is very expensive, even after 4 quarters in a row of declining revenue and sales. Okay, but if you go look at their earnings, and the reason I point this out, think of us owning the company Apple and not the stock, right? If we calculate that, if we bought Apple right now, the three of us, the price we pay, right around $3 trillion to buy the company, the amount of profit we'd be getting off Apple would equal about a 3.25% return on our money per year. Okay, well, we can go buy a guaranteed, a completely risk-free U.S. government bond that pays 5%, right? It's supposed to be inverse, right? The reason we're willing to take stock market risk and risk on individual companies is because they will pay us more, which justifies that greater level of risk.
Right.
Well, you're looking at it now, and it's completely flipped. So I think there's a lot of benefits out there that can be had by investors with higher rates, like you mentioned, bonds. I think that, again, cautiously, because rates could still go a little higher despite what people are saying. But I think a lot of mortgages that have blown up. We just bought a real estate investment trust that owns AAA rated mortgages, and it's dropped so much that we're getting a 20% dividend off of it per year.
My God.
Right. Yeah. And then as rates lower, those mortgages will go up in price. So I think there are a lot of attractive things out there to actually invest in. I just think the average investor is looking at precisely the wrong. Like the stock market has been on the biggest run in history, the biggest bull market in history. Great. That's not where the value is right now. The value is in that kind of stuff that we're talking about. And unfortunately, like other periods of times in our past, when we've dealt with inflation, I think stock market investors are going to be very disappointed, if not hurt badly.
Interesting. Okay. So I know that we saw that you've got one of your infamous free webinars coming up soon. Tell everybody how they can take a listen and get more of your expertise.
And how long are those usually, Zach? How, like when people get involved, when people listen to one of those, how long are they usually? What's the investment?
Funny enough, they're scheduled to go about 40 to 45 minutes, but we probably, and some people do, right? They just go to the end of our presentation explaining what makes us different, how we're active managers and risk managers and all that kind of stuff. So they'll log off right away. But a lot of times the Q&A session goes for another 45 minutes to an hour. So yeah, but the presentation itself is 40 to 45 minutes. And after listening to it, you're not going to know, we can't describe every single thing we do in 45 minutes, but you're going to have a really good understanding of what does make us different, how we don't just slap you in mutual funds and ETFs and tell you to write it out all the time. Our active management, our risk management strategies. And so you'll afterwards, you're going to have a really good understanding of who we are, what we do, and how we lower fees, increase upside, and drastically reduce risk. And that's kind of our calling card. And you can get that. You can sign up for it's completely free. We don't track your information. We don't keep emailing you. You can sign up at our website, bulwarkcapitalmanagement.com. And yeah, that's coming up next Thursday. So I think it's a great opportunity to kick the tires without any obligations.
That's
and
the 16th,
Thursday,
right?
yeah, November 16th.
Yep.
Yes. Yep. At 3 p.m.
3 p.m.
Pacific Standard Time. Yeah. Pacific Standard Time. I'm on a global podcast here. I gotta clarify.
That's right.
There's a lot of people that are Central and Eastern. We've got to make sure that we're cognizant of that. Okay, everybody should check that out. Totally.
Absolutely.
Check that out.
Thanks once again, Zach. You always break it down in a way that makes it just really a lot more palatable than any other of those wonky people on TV do. So we appreciate it.
Well, thank you, ladies. And thanks for having me on. I enjoyed it as always.
Thanks,
all right.
Zach.
We'll see you next time.
Investment advisory services offered through Trek Financial LLC, an SEC-registered investment advisor. Information presented is for educational purposes only. It should not be considered specific investment advice, does not take into consideration your specific situation, and does not intend to make an offer or solicitation for the sale or purchase of any securities or investment strategies. Investments involve risk and are not guaranteed, and past performance is no guarantee of future results. For specific tax advice on strategy, consult with a qualified tax professional before implementing any strategy discussed herein.